One of the most important things um, we can ever learn, or the reason why we are learning at the end of the day, is so that we know our entries, where to enter, right? Most people struggle with entries, and then at the end of the day, um, they forget the most important rules when it comes to trading entity. So now, let's do this. I think over the days, over the months, and some people that I followed over the years, you've seen how I take my entries. Right. If you go per book, they are what they call entry models. And my entry models, at the end of the day, they are basically ways in which one can enter in the market and it. So I will sort of like repeat what I have said before, but at the same time, I will want you to open your eyes, right? So, given the fact that we have approached an OB, let's say this was our order block, right? This is our order block. And right, let's mark it like this. So this is our order block, and we are convinced that this is our order block. And it first things first, we mark our OB. So let's come and mark it. And once we get the area of our OB, you'll find out that we have order blocks that have tails and it. When I'm marking an OB, I like marking it with its tail. So if it has a tail, I like marking it with the tail. I don't like separating the body from the tail. Why? Because order blocks, they have a tendency of wicking. When price comes to these OBs, it has a tendency of wicks, right? Right. So when we mark our OB, before we get into that, our senses should tell us, oh, according to what we know, we should know that. Let me remove this. We should know that when we approach, I wanted it to be small, but it's big. Is there anything else that I can use here and nothing? Okay, yeah, like this. So what we should know is our stop loss is always above our OB. Although some people they like putting it directly on the tail. Just because price is a tendency of wicking, I like putting it just above the wick. And then sometimes what I do is if I want to be very careful with that entry, I measure my body of that order block and then that's the stop loss that I'm gonna put above and then here lies my stop loss. Although the order block entries were designed in such a way that we are supposed to just come and place our stop loss above the OB. So, so at the end of the day, what we want to say is we want to let price come in our OB and it. Sorry for the silence. I thought someone was knocking at my gate. Sorry about that. So we want price to come in our OB with a perfect market structure and it. Now, OBs. They're different from gaps. The moment we get in an OB, we start taking entries. It doesn't matter if it was not filled 50%. As long as we tap in that OB, we start taking entries. And then you find out that sometimes price might come as far as reaching at the extremes of your OB before it falls. And then sometimes what it can do, this is now what's very frustrating. The most frustrating thing is you see your OB come weak on that area and then fall. Hence, the reason why we are putting our stop loss a bit above the tails and the. So now when you enter your OB, where is your take profit? Now that you know that you have your stop loss in place. So the way I like putting my take profit is, let's say I've seen this OB in M15. Obviously, what I'm gonna see is I'm going to have, let me come here. I'm going to have my structure playing out right. My first target would be the low, and my first target would be the low, which is here. Meaning that if I take at least two entries on this entry, my first take profit is here, right? I don't put it directly on the low. I put it a bit above the low. Why? Because remember, you might have a demand zone in this area, and then once you reach that area, your price will tend to come, then respect, leave another OB here, then fall. This is very common and this is very possible. Are we understanding here? Are we understanding?
Mhm.
Are we understanding, guys?
Yes, sir, we are understanding.
Right. So this is our entry when using order blocks and it. So let's move on to the next entries using fair value gaps. So using fair value gaps, what you will often see is if you discover that you have your fair value gap, and let's say this is our FVG. So on this session, I'm generally working with my diagrams. On the next session, that's when you're gonna work with the actual chart. So let's say this is where our fair value gap is. Now, what you can see is sometimes, okay, let me do this. What you can see is sometimes what you can see is sometimes you can have a bigger fair value gap in M30, but then now you don't know whether you should enter using that fair value gap in M30 or in H1. Now, this is the only time I think I'm going to go on the charts. So, for example, we have this is our V25, right? And we are on our daily time frame. And if we mark this fair value gap, what you are going to see is we can't take this entry just from the daily chart and but we are deriving it from the daily chart. So what we need to do is we need to go on to smaller time frames and then we need to go through a process what we call refinement. Now what you see here, all the way. There was healthy price action, like I told you yesterday about healthy price action. There was healthy price action, but there's a moment when buyers vigorously started overpowering sellers, leaving what in the market, leaving gaps. So instead of your gap being bigger like this, you can actually see that it is reduced in size, right? But since this is the 2 hour, you just can't say in 2 hour I've reached this area and now I'm executing. You also need to go into a smaller time frame, say the M15. So let's refine it to M15. Now, what you see is that gap again, it has reduced what? In size. And as it has reduced in size, there are scenarios when you're going to have confusion. And 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 when you have that confusion, what you're going to see is, let's say you see you have another gap at the bottom. So generally what I would do if I get two gaps in my smaller time frame, but one gap in my bigger time frame, one gap in my bigger time frame, what I do is I like utilizing them both. Meaning what? Meaning it's very easy to read market structure in these smaller time frames. And when my trade comes, it's easy for me to see that it has broken and it's not reacting on this gap, or it's easy for me to see that it hasn't, but it is giving me a good structure shift and then it continues going up. So unlike order blocks now, when we are using fair value gaps, our entries, we have to wait for the fill of the 50% and it has to fill 50% of that gap. So when price comes, now what you do is you simply mark your 50% of your gap. When price comes into that gap, when price comes into that gap, you buy it. Sorry about that. You wait for it to fill the 50%. You wait for it to give you your confirmations like we always do, and then you sell it. So this is our entries for gaps, right? So now we go to breakout structure and change of character. We go to breakout structure and change of character. Now, as I've taught you about breakout structure and change of character, um, we're in an uptrend, right? Us being in an uptrend, if we come and we take out this low directly, this is a breakout structure. Why? Because this low over here, and it was a protected low in the event that it broke this high. So when this high came and took this low, it means we have a break of structure. Now, when we have a break of structure, what's the most important thing we should do as far as trading is concerned? We wait for it to give us a new low, and we wait for it to give us a new low. Once we are convinced that we now have a low, what do? We take our fib, we measure. Since now we are saying we are selling, we take that fib, drag it from the high to the low, and what we now wait for is price to come and react in our reaction zones. We have the 0.58, the 0.61, and the 0.71, like I said. We wait for market structure in smaller time frames to come into those zones and give us a play out. So sometimes it's not always that it should play on the 0.5 or 0.61 or 0.71. It can choose wherever it wants to play out and then it falls. But then sometimes you find out that your 0.618 or your 0.71 or your 0.5 can align with a gap. Most probably you can find out that there's a gap here. And when you see that there is a gap, this now becomes an added advantage to who? To you. In what event? In that you now know that you have a powerful entry around this area. So sometimes I would rather say I'm seeing that price is buying, but then when I reach my but when I reach my zero point 0.5, I try to look what else is there that I can utilize. And then if I immediately see that around the 0.618 is a gap, obviously that would be my area of interest. Why? Because price is gonna come there and most probably play out from that zone. Are you understanding here? Are we understanding?
Yes, yes, we're following.
Right. So we now want to use a change of character. Now, unlike unlike a breakout structure, what we want to use when you say a change of character is we want our trade to come, fail, break that high. The fact that it failed to break that high is the one that's going to justify why we are saying it's a change of character, and we want it to break that low. Now, what happens is when a low fails to break a high, the low becomes weak, so we have to come and hunt it and break it, right? So, us considering that we were in a strong bullish momentum, but then all of a sudden we failed to break the high, it raises alarm, and that alarm, when it comes and breaks the low, which is the internal law, that is now our change of character. Basically, it's telling us that price might just change from an uptrend going to a downtrend. And then what are we looking at? We are looking at price coming and giving us a breakout structure. And why do we now term this a breakout structure? Because it broke this previous high. Now it becomes a protected low. So since it's protected, we are now waiting for price to come give us a breakout structure. And when we retrace again, we wait for it to give us a low and then we buy from that low. Remember, we take our fib, right? We have two types of traders, those who buy to sell and those who wait to sell. Then we take our fib, we wait for retracements and it. Remember, there's always things on the lookout. We have to look out for order blocks. We have to look out for gaps as well, fair value gaps. That's where price is most going to react if we align it with our fib. Are we understanding there?
We are following. We are following.
We're following. All right. So as far as our entries are concerned, and some of our entries are concerned, I just thought maybe we could do a quick recap on this and emphasize on our entries. So I'm going to record this session and then post it in our Telegram group. Our 30 minutes is now up. Thank you.